Back. It's time to check in on the activity playing out on the Forex market scene now. And joining us for that conversation, Jameel Ahmad from Forex Time. Jameel, thanks so much for your time this evening. So we've had the dollar weakening as investors bet that lower oil prices will reduce inflationary pressures and make it less likely for the US Fed to push ahead with rapid rate rises. That's the commentary, but rapid rate increases was never on the agenda, was it? What do we read into today's dollar reaction?
Thank you very much for having me. So, of course, over the near term, we've seen some pressure on the dollar and actually a few other major currencies because of the fluctuations in the price of oil following the price of oil reaching a 2017 low. But let's switch to the Federal Reserve because it's a major talking point and the hot topic. The markets have been caught by surprise by a very optimistic and upbeat rhetoric from the Federal Reserve, which generally speaking we're not so used to. And the Federal Reserve are talking positively about the US economy. Also, they seem to be talking positively about the prospect of more interest rate rises in the United States, which should be positive for the US dollar over the medium and the longer term, which also means that the emerging market currencies such as the South African rand might come under pressure over the medium term by the prospect of higher borrowing rates in the United States.
Yeah. How much risk are you pricing into a currency like the rand at this stage, Jameel, where, of course, we've derived a lot of benefit from capital inflows into the market as investors, foreign investors in particular, go in search for yield?
Yeah, of course. South Africa is one of the main beneficiaries of the carry trade, and when investors are searching for yield, it benefits from capital inflows. So at the moment, the Federal Reserve were expected to potentially raise interest rates one more time in the United States over the next 6 months. This is probably going to be the case, and investors will start pricing this into the dollar, which is when inflows in all of the emerging markets, including South Africa, might come under threat. But the problem now for the emerging markets is if the Federal Reserve hints, and at the moment it will just be a hint, that they could raise interest rates more than once over the next 6 months. Now, if this was to be the case, this would be much more significant in terms of dollar price pressures. The dollar would get stronger across the global currency markets, which means emerging markets would come under pressure. And this would also put even more threats at capital outflow, which is when an emerging market like South Africa would face a problem from significantly higher interest rates in the United States.
I assume that risk intensifies even further where you've got the likes of a sterling rebounding from 2-month lows today, trading back above the 127 handle after BOE chief economist Andy Haldane signaled that he would weigh in behind a rise in interest rates in the second half of this year. Do you think that the UK economy is ready for a move like that? Because that commentary is standing in contrast to the comments we had from Governor Mark Carney earlier this week.
This is a very interesting topic that's developing in the United Kingdom right now when it comes to interest rates. We're actually seeing dissent and a period of disconnect between different members of the Monetary Policy Committee. Now, the Monetary Policy Committee are voting members within the Bank of England. Now, the sterling has bounced higher over the previous 2-3 hours because of the comments from Andy Haldane over the prospects of higher interest rates in the United Kingdom. Now, traditionally, Haldane is seen as one of the more dovish members of the Bank of England, and he likes lower borrowing rates. But he seems to have changed tune, and following the 3 dissenters from the recent Bank of England meeting, the story is developing over whether the United Kingdom could be raising interest rates. Personally, I do not think it's going to be the case because the economy is going to be entering a lot of uncertainty with the Brexit negotiations. They're only just starting to take place now, despite the vote being 1 year ago. And it probably does warrant the lower borrowing rates in the United Kingdom because the economy might face some sort of hurdles as these negotiations get underway.
Jameel, I was just going to say, with the data surprises and the central bank rhetoric driving reaction today, that political risk seems to have dissipated somewhat, How much of a concern is it still, Theresa May and her negotiating power at those Brexit negotiations? Because while it may have lost some of the attention today, as you highlight, it's still very much front of mind.
No, political risk in general is still something that seems to be dominating the market headlines, as it has been throughout this year. Now, what we have seen over the past couple of days is more movements and reactions to central banks. But Theresa May and political risk, whether that's due to UK elections or the ongoing EU negotiations, which are going to take place for a significant amount of time, it's going to take up to 2 years for the UK to finish these negotiations and to actually leave the European Union. Now, it does appear that Theresa May, the UK Prime Minister, will pursue more of a softer Brexit approach, which may erase some of this political risk in the background. But still, nobody really knows how these negotiations are going to go.
Yeah, we wait and see. Jameel, let's leave it there. Thanks so much for having joined us on the line this evening. Jameel Ahmad is Vice President of Corporate Development and Market Research at FXTM.